Hello and welcome everyone. This is Ajay Sabharwal. Welcome to all of you to our session today on Forex and the USD INR outlook, especially focusing on the COVID-19 and the post-COVID-19 world. We have today with us Mr. Pranjal Chaturvedi, who's an MBA from the Indian Institute of Foreign Trade and presently a management associate at DBS Bank. He has some extensive experience in the world of Forex and as well as Forex derivatives. Pranjal, it is an honor and privilege for us here at the IYEA to welcome you for this session. I've gone through some of the slides that you'll be sharing with our mentees today, and undoubtedly they look really interesting. This is a very interesting topic area of some personal interest to me as well, and I hope that the mentees today can take back a lot of new insights apart from whatever is the conventional and mainstream media in this regard. So Pranjal, I'll hand over to you from here.
Thanks, Ajay. Thanks for such a kind introduction. But yes, agreed. It's a topic which is not only very interesting, but I think it's a topic which is often ignored. We do obviously read a lot about USD INR movements in the newspaper or on other blogs on a daily basis. But I think a lot of people don't understand the importance of USD INR as a whole to the nation and the economy of the country. So yes, I've tried to keep it as interactive as possible. And what we are going to do is, over the next hour and a half, is run through some of the key principles that impact USD INR on a daily basis. But we are not only going to look at short-term predictions. So it's not 6 months from now or a year from now. Our holistic approach right now is to understand the currency pair as a whole, right? What has happened in the past? What are we facing right now with the COVID pandemic, sort of putting in very, very serious challenges to all emerging markets, as well as the developed world. And then we'll try, basis our understanding, whatever we've discussed, to see what lies in the future for this currency pair, whether we see the rupee going further, some even may say to 80 levels. So we'll first start, and I want to keep the session as interactive as possible. I understand we have a chat option. So in case you have any questions, please put it on chat and I'll be more than happy to answer them in between slides, right? So let's start. In the first slide, I'll give you an overview. Yes. So now what I've tried to highlight in this slide is how the rupee has behaved since the start of 2020, right? So as Ajay introduced me, I'll give you a slight idea. I work in the markets team of DBS. So I have a daily interaction with large corporates who deal in the currency pair, and I deal in it myself in terms of transacting the pair. So I'll give you some practical insights on what I've seen throughout 2020. So here on the left, you can see a chart. Okay, this is a Bloomberg chart. This shows what the current exchange rate of dollar INR was yesterday. So it closed at close to 75.64, right? Now, what does this mean? We started off the year on a very good note. And as you can see, I've divided the movements throughout the year in different phases, in 4 different phases. So 2019 ended on a slightly pessimistic note. We had some trouble brewing geopolitically. We had the US-China trade war, which had been impacting the currency pair throughout the year. But at the start of 2020, there were some green shoots, okay? And you can see it in the graph very clearly that rupee ended the previous year, at close to 72 levels. And we recovered from 72 to 70.80, close to that level, which generally is a good jump. If you have a 1 rupee move in a matter of a couple of weeks, that is considered to be very healthy. So we entered a phase from January and February where we saw the currency pair being very flat. So it was trading in a range. It wasn't going in any direction. And that generally happens when the markets and the participants in the markets are looking for certain news and global or domestic cues to find a direction. And they got that cue from, of course, the whole coronavirus pandemic. First 2 months, it was mostly China centric. So the markets were not that spooked out. But when we entered March, things started to change, especially when there were few cases of coronavirus that had entered India. So that is the phase that you can see. At end of March, you see this huge spike. And this huge spike goes up right till the point where dollar rupee touched 76.23 on the 23rd of March when the lockdown was announced, right? And the reason for this huge spike was very simple. I mean, people have never seen such an unprecedented event, at least in the last 100 years, right? So you have a situation where in India's history, you have a complete lockdown for the first time. And people were very worried in terms of what will happen to investor sentiment. So we saw the dollar rupee spike up and go till 76.23. Till that time, investors had understood that this is a situation they would have to deal with. And we also saw some RBI intervention. So RBI makes sure that whenever there is excessive volatility in the market, it will come in and either buy or sell dollars basis which direction it wants the currency pair to move in. At this point in time, dollar was seeing massive strength. A lot of investors, whenever there is a global crisis, prefer to hold currencies of developed countries, and especially prefer to hold the US dollar because it allows them to go and invest in safer assets abroad. So once we have had this spike, we entered what I call phase three, and this was a phase where the new normal, if you may say, was starting to impact rupee very negatively. So we saw rupee, already we were at all-time lows with 76.23. We saw the rupee further facing headwinds because people didn't know whether they'll be able to come out of this lockdown very soon. So we saw a lot of asset classes in India, including the equity markets in March, face a lot of selling, and a lot of institutional investors started, FPIs started pulling money out. That is when we touched 76.92, which is now the all-time low of USD INR. So once we touched 76.92, again, we saw some RBI intervention in the market, and we saw some cooler sentiments prevail. Post which I think we entered a phase of long drawn, of range bound trading, which is the phase fourth, as I've mentioned here. Now, it is a very interesting phase because what happened was in the third or fourth week post the lockdown, we started to see some sort of normalcy creep into life, right? Markets opening up, companies restarting businesses, restarting factories. We also saw a lot of institutional investors coming back into India. So a lot of you would have noticed that the equity markets, Nifty and Sensex, rebounded after the massive selling they saw in early March. Now, a lot of people are questioning whether that rebound makes any sense, considering that the facts on the ground haven't changed that much. But from a currency perspective, we saw a lot of inflows. So capital inflows have a major impact on the market. And all of you would have read that Reliance was raising capital from international investors at a very fast rate, close to $13 billion. So when $13 billion enter the Indian market and the dollars get converted to rupee, people were expecting rupee to rebound and the USD INR pair to come down to 74 levels. But what was surprising was every time it got close to 75, RBI and other PSU banks, which were buying on behalf of RBI, started buying dollars very, very aggressively, hence pushing the pair up again. And a lot of you people would be a little confused in terms of why RBI was buying at a high level of 75, 75.50. And the reason is very clear. RBI wanted to buffer up India's foreign exchange reserves. The Forex reserves have reached an all-time high. They've crossed $500 billion. And this sort of gives them a safety net, which is something I will highlight later as well. So these are the broad four phases that we saw in 2020. Now, I want to put this in context for all of you, right? Now, a lot of you might be thinking, okay, rupee at 71 or rupee at 76, 77, does it make much of a difference? And is it good or is it bad? Or was every currency in every country facing heat? Now, what I've done is I've given you a comparative analysis here. On the left, you will see a chart. This is called the dollar index. This is something which is maintained by Bloomberg. Now, the dollar index, what it does is it compares the dollar, because the dollar is the reserve currency. So literally every currency in the world is quoted against the dollar primarily, right? Whatever rates you might see, euro, INR, those are cross rates. The most important rate for any currency is against the dollar, okay? So this measures the dollar strength against a basket of currencies. Majority of those currencies, the weightage, majority weightage is with the euro, the Japanese yen, the Canadian dollar, pound, and the Indian weightage is close to only 2% of the index, right? So here you see that dollar has gained 1% since the year started, close to 1%. Now, this shows that during this crisis period, investors have preferred buying dollars and keeping dollars with themselves rather than keeping other currencies, because again, it goes back to the fact that dollar is the reserve currency, is the most traded currency. It's the currency which is used most widely in the world. Hence, we saw it rise 1%. But what is important here is that this 1%, you should include that euro strengthened against the dollar this year. And so did the Canadian dollar and the Japanese yen. Whatever gains it has primarily made against weaker currencies or emerging market currencies. Now, whenever you're comparing the Indian rupee to any other currency, it is important that you compare it to Asian currencies, okay? Currencies, if you think of it as an asset class, okay? If you think of it as, let's say, equities, what will you do if you wanted to compare a stock performance? Let's say you take the stock of any private bank in India. You will compare it against other private banks, right? You will not compare it against a company from another sector. So here, what I'm going to do is I'm going to give you a very quick comparison between the rupee and Asian currencies, which are generally very highly correlated. Now, I've also divided it between developed currencies and emerging currencies, because generally they have slightly different dynamics. So in the developed currency space, you'll be able to see that the Thai baht, the Korean won, all of these currencies depreciated against the dollar, okay? And they depreciated generally in the bracket of 3 to 4%. The only currency that did well was the Taiwanese dollar, right? The Taiwanese dollar, and the reason it did well was because, first of all, Taiwan has insulated itself quite well from the coronavirus. So they have done very well in that aspect. And the investors basically rewarded them by investing in the country. Similarly, JPY you would see also actually advanced against the dollar, did not depreciate. And the reason for that is the Japanese yen is traditionally considered a safe haven. So there are 2-3 currencies which always do well when there is heightened volatility in global markets. One of them is the Japanese yen, the other is the Canadian dollar. All of these are generally considered very safe currencies, hence it's not a surprise that they actually benefited from this. In the emerging market space, though, is where things get a little more interesting. You would see that the most comparable currency to the Indian rupee is probably the Indonesian rupiah, because Indonesia is also an emerging market, high interest rate market, but their currency only depreciated close to 2.5%. Similarly, the worst currency there, apart from INR, is the Malaysian ringgit, which depreciated close to 4.88%. But what I'm trying to highlight here is that INR was the worst performing currency of the year so far, out of all its Asian peers, which is concerning because it depreciated only 5.97%, which is very considerable. The only other currency from, let's say, the underdeveloped world which performed worse was the Pakistani rupee, which depreciated 8.3%. But then this is not a comparison. This is just something I wanted to show you that we are not doing well from a currency perspective right now. As we move forward, I want to put this in context. Okay, so is it that 2020 was a bad year, but it was, let's say, a rare year, that this doesn't happen every year and it's not going to happen every year? But the case, it seems, is that the rupee has been performing badly or underperforming for a long period of time. So it is not only a problem which has emerged in 2020. it's a consistent trend that we've seen the rupee in for now, I would say decades. It's been a long-term trend. But I've only picked up last 5 years to give you a bit of context. Now, if you look at 2015, 16, 17, the left part of the graph, you would see that markets have remained choppy. Okay, but they were still within a range. They were not going sharply in one direction. Okay, in 2018 though, in 2017, sorry, we saw a very good performance from the Indian rupee. And on the last few years, I would say that is the only year on record where the rupee has done well against the dollar. And 2017, I think it was just some optimism where the economy was doing okay. Crude oil prices were slightly subdued. So we had a good year there. But then you would see in 2018, we had a horrible spike. I mean, dollar rupee went suddenly from mid 60s and it touched an all-time low of 74 within that year. And the reason behind that is that in 2018 we had multiple crises from a geopolitical front, and we had a lot of Asian currencies that were seeing massive selling. So to give you an example, we saw, of course, the US-China trade war also heat up, or begin. We saw the Trump rhetoric increasing. We saw a crisis in Turkey where the Turkish lira depreciated almost 40% in 1 year. We saw also a crisis in Argentina. And believe it or not, if you have crisis in even Argentina or Turkey, it does have an impact on the Indian rupee. It has an impact on a lot of emerging market currencies, because then investor sentiment globally gets hurt and people just want to go and invest in safer assets. We also saw crude oil spike up again. So crude oil touched close to $65, $66 a barrel, which at that time was still high because remember, it was recovering from lows of close to $35, $40 a barrel. And India's import bill was increasing substantially. As you would know, and as I would touch in the subsequent slides, India is a net importer, a heavy importer of crude oil. So that has a very, very big impact on the currency pair. So again, this year, as I've already highlighted, has been very bad. But my submission is, this basically highlights that the rupee is very, very open to tail risks, to any unexpected events, not only within the contours of its border, but also beyond that. It is what I would classically define as a high beta currency, a high risk, high volatility currency, because it reacts very sharply to such news. To give you a practical example, when we had the Galwan clash on the 15th of June, I was active in the markets at that point in time, and the day had been very, very calm. But as soon as the news broke in, we saw a 40 to 50 paisa move in dollar rupee, which is a big move. So there was a sudden spike up. And this is what happens. These things have major impact on currency pairs. And that's why I think it is important to understand that this is a longer term trend, not a short one. Now, moving forward, we've talked about charts. We've looked at a 1 year trend. We've looked at a 5 year trend. We've done a comparative analysis. Now, my idea is to dive a little deeper into what is it that determines the price of USD INR. What are the key determinants? And a lot of these would be points which will also help you when you are analyzing other currencies. So keep that in mind. But then I have specifically designed it in a way that it focuses a little more on the rupee, because there are a lot of specifics to how USD INR moves. So the first one is, it's very important to understand the basics of currency movements. Okay, at the end of the day, currencies are a mode of or medium of exchange, right? So it's not only speculators and geopolitical news or that drives markets. What drives markets also is fundamentals. So in terms of exchange of foreign currency, you need to see how much trade is India doing with the world, right? India does substantial amount of trade. I mean, it's not a small player, but it still has a lot to catch up in terms of being an exporting powerhouse. Okay, India has been running a trade deficit for ages. That means that India imports more than it exports. So it net, it gives out foreign currency rather than earning any foreign currency from a trade perspective, which is always bad for your currency, right? So India Traditionally, as a part of the import also, as I told you, has been a very, very heavy importer of crude oil. It has also been a very heavy importer of other non-essential, like oil is essential, but non-essential items like gold also. India is a very, very heavy importer of gold. Also, from an export perspective, India has been seeing very, I would say, mid-value exports into the global markets, except for maybe pharmaceuticals, where India has a very good hold in the international front. And also a lack of free trade agreements and regional comprehensive partnerships, the ability of our trade diplomats to get those deals finalized has also impacted our ability to become more of an exporting powerhouse. So having a trade deficit always impacts your currency negatively. And because we've had a trade deficit of close to 70 to 80 billion dollars, $100 billion consistently every year, that has meant that this trend is always supported by this fact. Also, another thing I want you guys to concentrate on is how do currencies get traded? So for people who have experience in equities or any other capital market instrument, would be more uh, used to thinking of trading from an exchange perspective. So if you deal in equities, you will always have an exchange, right? So the National Stock Exchange, Bombay Stock Exchange, those are all exchanges. But currencies are not very exchange driven. Currencies are what they call OTC traded, over the counter traded. So generally, this is done on a bilateral basis. So they're like two parties dealing with each other. And what are the parties? Banks are, of course, the biggest party in foreign exchange. Banks control uh, by far the majority of the market globally. Okay, it's a 24 by 5 market. It's 24-hour active on all the weekdays, and all the banks globally are very active in it. They trade directly with corporates. They trade with retailers. They trade with retail customers and clients like us. Also, the second part of big participants in this market are investment funds. So banks not only deal with corporates and clients, they also have a lot of big trading teams that trade in currencies. And their perspective out of this trading is to make money, right? So these guys will obviously react to news, they will react to sentiments, and they will know where the market is moving because these guys control it to a great extent. So please just keep that in mind when you're thinking about currencies. The other part is, now I just told you that India has a trade deficit. Then how is it that India has over $500 billion in forex reserves if it is not getting any, right? But that's not true. So if we come to capital flows, India captures a good amount of FDI inflows. If you look at FDI data, you will see for the last many years, India has been probably the top destination for FDI in Asia, attracting close to $50 billion on an annual basis. Also, we see a lot of portfolio investors investing or trading in Indian markets. Both the NSE and BSE, Nifty and Sensex have big market caps of above $2 trillion. So we have a lot of foreign investment coming in. And that is where the RBI becomes active and laps those dollars up to ensure that India has a good amount of buffer when it needs one. Then the fourth point I think is crucial. This is something I also highlighted in the earlier two slides, is that the central bank interventions in the foreign exchange market are very commonplace, but also very critical. So just to dive a little deeper into this, why is it that central banks participate in the forex market? Okay, so the stated objective of the RBI is that we will participate in the currency markets when we think there is high volatility. So in order to ensure that the rupee doesn't go crazy and doesn't lose 10-15% in one go. At the same time, they also said that we will participate when we think uh, that it is required from a market perspective to give market some direction, to give market some liquidity. Okay, liquidity is an important term. So not only that, but as I told you, we have seen RBI being very aggressive this time around in terms of buying dollars at close to 75 against the rupee. And this tells us that RBI thinks that rupee is going to depreciate further because they think 75 is a good level to buy dollars at. So if you were, let's say, an investor or if you were somebody who just follows the currency pair, you would think of it from this perspective, saying that if RBI is buying heavily at 75, it certainly is happy with the rupee going lower and lower. Okay, so that is again a very, very interesting and important point. Now, another thing is, of course, the economy of a country has a major impact on its currency. Uh, we saw ever since 2001, 2005, when India actually began entering a high growth phase, we saw more and more interest from international players for investing in India. So economic growth is very, very important. But uh, at the same time, how the government reacts, is the government investing heavily from a fiscal perspective? Is the budget something that the investors like? How much is the fiscal deficit? So another important point, the fiscal deficit has a major impact. I'm sure a lot of you economics students especially would be tracking that India is a net borrower, right? India doesn't have a surplus when it comes to its budget. In order to meet its budgetary obligations, it obviously picks up money from the market and borrows. And generally that borrowing has been prudent to some extent, capping the fiscal deficit at close to 3.5% for this year. That was what was expected until coronavirus hit us. Now there are many estimates that because government revenue completely dried up and the government had to borrow substantially more, that we might be in a situation where the fiscal deficit might touch 12%. Okay, so that is very worrying, and that has certainly had a major impact on investors and speculators' mind, and that has also contributed very, very heavily to USD INR touching all-time lows or all-time highs from a dollar perspective. Now, conventionally, when you read about currencies in a classroom, you would of course read about factors like inflation and interest rates, right? Now, it is important to understand that in currencies, there are obviously two currencies that you compare against each other. So you have to look at two economies. You can't look at the Indian economy in a silo, okay? So the period of slowdown for the Indian economy was also met by a period of buoyancy in the US economy before coronavirus hit. They were doing very well. So that, of course, meant dollar strength. But if you look from an interest rate and inflation perspective, I would say India was in a cycle where India was cutting interest rates, okay? If you look at the repo rate, even before coronavirus started, the RBI had started decreasing interest rates. And the reason for that was our economy was already slowing. You know, our GDP numbers before coronavirus hit us was close to 4.5% growth a quarter, which for a country like India is very bad news. So we were seeing the government push up expenditure, trying to bring in reforms, where we had Ms. Sitaraman coming in almost every week and announcing something new. But we also had RBI cutting interest rates, trying to prop up lending in the economy so that activity increases. So interest rates in India were going down, whereas interest rates in the US pre-corona were stable. They were already low, and the Fed said, we'll cut a little, but we will not cut a lot. Okay, so when the interest rates are closing in, an emerging economy is coming down, a developed economy is almost stable, you would almost always see investors taking money out of the emerging market and going to a safer place. Because unless the emerging market is giving it high interest rates, investors don't want to stay there because they're taking extra risk being in a country where there is a lot of volatility. So we were already witnessing that. From an inflation perspective also, India only recently in the last 6 months before coronavirus had started seeing an inflation spike, which was not the case earlier. Earlier, the inflation was much below RBI's target of 4 plus minus 2%. Because it was increasing, that was also tethering investors and also impacting the rupee. Now, another very interesting topic, and post this slide, I will just pause and I will give you guys a few minutes to ask me some questions if you have any before we move forward. But a few important points here. There is a non-deliverable forward market. You must have seen one of the points listed here is NDF markets. What are NDF markets? So you need to understand that rupee is a the country has capital controls of the currency. That means that you cannot freely exchange rupee or use rupee outside of the boundaries of the country. There are capital controls in place from the RBI. So a lot of foreign investors wanted to hedge rupees, but they were not able to participate in the Indian market. So we saw in the last few years, and other countries, exchanges in other countries saw an opportunity for this. We saw an offshore market being developed for the Indian rupee. We saw a market being set up in London. We saw a market being set up in Singapore. We saw an NDF market being set up in Dubai. So here investors could come and trade in USD INR. They did not need to exchange the currency in real life. They could just take a bet or just hedge their exposure and cash settle it on a foreign exchange. So it actually became, the NDF markets became so big that only London does double the volume of rupee trading than India does on its own markets. So it is very funny, right? You have the Indian market where the Indian rupee is your currency, but the London market has double the trading volume than the domestic market does. So this started worrying the RBI, because the reason was overnight. So these markets are in London and Singapore and other places. So of course there are timing differences from the Indian market. So they open up in the evening and they are active through the night. Okay, so what started happening was, because everyone could come and trade in the non-deliverable forwards market, the price swings in the NDF market were much, much larger than on the onshore market. So as the overnight prices were moving sharply outside, domestic investors started using those offshore prices and started trading in the same way on the onshore market. So the actual USD INR started getting impacted by the NDF markets. So the RBI got worried that, okay, offshore market is impacting our onshore prices. So what they started doing recently was, before coronavirus, they came up with certain market reforms. And this is something which you have to give the RBI credit for. They made dollar rupee a 24-hour market in India. Earlier, the timings were 9 to 5. They said anybody who wants to trade 24/7, they can trade with a bank if the bank is willing to trade with them. Okay. Right now, it's constrained because of the coronavirus pandemic. It's only 10 to 2. But when things go back to normal, we'll go back to 24-hour trading. And they also allowed Indian banks to go start trading in the non-deliverable forwards market. So what this does is it allows Indian banks to participate offshore and hence influence that market. And then they can also trade onshore in the mornings. So RBI can also now go and trade offshore. So this is just to integrate the two markets in a way, right? Now, finally, what I've said is, whenever there is an increase in uncertainty, okay, just memorize two words. In Forex markets, two words are very important: risk off or risk on. Okay. Whenever you have a situation where there's a lot of uncertainty, okay, like the coronavirus, like India's, geopolitical border struggles, or let's say any other event that happens globally, investors get worried. Then they enter in something known as a risk off sentiment. So they don't want to take risks. So they start taking money out of high risky countries and high risk currencies, which of course INR falls in that category. So they take money out and then they start investing in safer assets. I told you JPY, Canadian dollar, they will always do well in risk off times. The US dollar will also do well, but it will be relative slightly. Then when you have a risk on sentiment, you should expect emerging market currencies to do well. So let's say 6 months from now on, we find a vaccine. 6 months from now on, we see a V-shaped recovery in the economy. You will see the rupee doing well at that point in time. So all of these are important factors. I think I've covered quite a few. I will pause for a minute here, and I would like to invite you guys to probably send me some questions over chat if you have any. Okay, I have a question. Where is India on crypto next 10 years? Okay, so that's an interesting point. But see, you need to view cryptocurrencies from a different lens. Okay, when you're talking about FX, can you look at a crypto like Bitcoin or Ethereum or any other cryptocurrency from a similar perspective? And my point is, I am pretty sure you can't. And the reason for that is, right now we do not have an exchange mechanism or an exchange value in cryptocurrencies. Once we see an increased acceptance from people around the world to actually trade in cryptocurrencies from a product perspective. So when I can go and buy a pizza or a car or a TV from cryptocurrencies, then I'll probably view it from a currency lens. But with that being said, it's a valid question. I think the market needs to be developed uh, a lot more. Okay, we saw cryptos touching close to, I think, $500 billion in trading, which is impressive. It's very good. I mean, it certainly tells us that there's a future for the market. But the currency markets are $6 trillion a day. Okay, so $500 billion market cap versus $6 trillion a day trading. There's a big gap to cover up. I think cryptos, if you're interested in cryptos and if you want to trade in cryptos, I would ideally tell you to become good at technical analysis. Be good at reading charts. It's all a chart play. It's of course very volatile, so you need to be well versed with the things you can do. Another thing is cryptos also do not have a very developed market for derivatives. Okay, so they're not options on cryptos that I know of, or not very widely used, very liquidly used. So until unless you have derivatives on them, trading might not be that liquid. Okay, so I have a couple of other questions. What are the NDF markets? Okay, so if there's still some confusion, let me touch on it again. See, what happens is, because the Indian rupee is capital control. That's what I told you, right? Foreign investors or any corporate cannot come and trade in Indian rupee until unless they want to actually exchange dollars for the rupee. Okay, so if I'm doing some business in India, it makes sense for me to come and participate on the onshore market. But if we are not doing business in India, why would I want to do this? Why would I want to exchange and actually buy rupees physically? The NDF market allows people to go and just buy a contract, and then later on they don't need to actually do the exchange. They can just settle the contract. If they have a profit, they take the cash in dollars. If they have a loss, they give the money in dollars. So it allows people to bypass the restrictions of the Indian market. The Indian market is very restrictive. Okay, there are a lot of restrictions, and the reason for the restrictions is we are a developing market. RBI doesn't want the Indian market to be very volatile, so there are a lot of restrictions. The NDF markets don't have that restrictions, hence they're much better for these things. Okay, now we have two questions. One from Ishika. Since there is no trade surplus and we are relying on capital flows, which we have to pay interest, so at point when our economy is sagging, can we pay high interest, or if there are any chances for diversification of forex reserves? Okay, so see, capital flows are not bad, right? Capital flows, you need to think of it from a perspective of what that capital is doing. Okay, uh, let's go to FDI and FPI. So if FDI is coming into the economy, if you have money coming in from an investment perspective, that is very good for you. Because they will come and invest in a new factory. They will come and build up new industries. They will hire people. They will pay them salaries. They will do business. Once they earn money, they will pay taxes to the government. They will export products from India. So all of these things are by far net positive for the economy. They're not taking anything out of the Indian economy. They're contributing a lot, right? That's why we have a relatively vibrant MNC space, and that is something which is propelling in many ways the Indian economy forward, right? The Indian services sector is doing very well, or was doing very well up till now, and one of the main reasons is because we had a lot of foreign participation. And if they come and invest in equities, that also is good. So it means that your markets are liquid. That means even smaller companies can come and do IPOs in the future. They can raise money from foreign investors. Look at Reliance. At this point in time, Reliance had more than 1 lakh crore of debt on its books. Okay. But they utilized this situation to turn themselves from a majority oil and gas corporate to now a predominantly a digital player. They were able to raise $30 billion because they did very well in that space. So FDIs and capital inflows are very good for us. And there is no need for, now Forex reserves diversification, that is something different. Forex reserves, any dollars coming in, the RBI literally just buys them to keep a buffer for the country. Okay, so quickly we'll just cover a couple more. One is, should we focus on the development of bond market in India to provide more liquidity to these currency pairs, or what else can we do to increase liquidity and depths of markets for trading these currencies? That's true. Yes, of course you need to focus on the bond market in India. Okay, but if you look at the bond market right now, it is predominantly focused towards triple A credit names. Okay, triple A, double A plus. Only good credits are able to raise money easily in the Indian bond market. India does not have what is known as a junk bond market. It's not very active. Okay, so if somebody wants to raise money in a high yield investment, right? You have a bad credit rating, or let's say you were Tesla in India, you wouldn't be able to raise junk bonds in the Indian market. You could do it offshore, but in the Indian markets, you wouldn't find that liquidity. So we of course need to focus on development of Indian market. What we are seeing is, from a personal perspective, as somebody who's privy to uh, bond deals in the Indian market as well, I would say that the RBI has done things to increase depth. And one of the things they've done is they've allowed FPIs, foreign portfolio investors, to come and subscribe to Indian bonds. Okay. So a lot of banks are setting up FPIs abroad, and they are investing in bonds of Indian corporates. And how they are doing this is, you've also must have heard of the masala bond, right? Which is, you can raise Indian rupee outside of India. So this is leading to deepening of the forex market, because banks generally raise dollar money and they swap it into Indian rupees and invest in these bonds. So that is a very good question. We do need to focus on the development of bond markets. It's a very, very important area. But I think the RBI and the government has been focusing on that in the last couple of years. Okay, so just the last question, and then we go back to this. This is more of a clarification. The RBI started buying USD to raise USD reserves in India, right? As a safety net. Yes, of course, they started buying dollars as a safety net. And the reason I'll tell you is, now you are, and I think it'll be better covered in the next slide. So let's move there. Yes, so now what are the implications for corporates? So we got 2-3 questions on the bond markets and things like that. This is going to give you an idea of that. This slide is slightly technical if you don't have a background in derivatives. So I'll just try and explain the overlying ideas behind it and not go in too deep. So the key observations that we have seen from the coronavirus is that there has been a massive stress piling up in the SME space in India. And it has been, what I've written here as well, is it has been primarily sector agnostic. Okay. So it has been throughout industries, throughout sectors, SMEs are facing problems. And the problems are, of course, because they've not had sales for 2-3 months, or very low amount of sales. Generally, SMEs do not have the cash reserves that large corporates have. So they obviously face a lot of heat, because they have to pay their employees, and they're not able to do any business, and they have inventories lying up, and all of these things creates massive stress. We have seen the RBI coming in and announcing the 3-month moratorium. They will still obviously have to pay interest on these loans. And because the RBI has also gone forward and told banks, do not recognize new NPAs for this period, do not recognize new bad loans. That is worrisome, okay? Because 3 months, let's say a lot of people default, and the banks do not report it as a default. 3 months later, suddenly you have a situation where your NPAs have been 10% for PSUs, and they go up to 15-16%. So a lot of reporting suddenly comes in. I think banks have already started doing some provisioning for this. So this is going to be an area where I would ask all of you to keep a close eye on, because this could be a risk factor for the Indian economy going forward. Also, the only major activity I've seen on the debt space is large corporates. what has happened? RBI has cut repo rates massively. Repo rate now stands at 4%. They did a 40 basis point, 0.4% cut in May, uh, which was expected, but they did it before even the next policy meet. So low interest rates means large corporates who have existing loans. So let's say they have a 1,000 crore rupee loan at 7%. They will go to their bank and say, I want to refinance this because now costs are cheaper, rates are cheaper. I want to refinance. Give me a new 1,000 crores to repay this old 1,000 crores and give it to me at 6%. So I save that 1%. So large corporates are doing a lot of this. They're investing in, the RBI came up with liquidity measures to, one was long-term repo. So banks could raise cheap money from the RBI at 4% and then invest in manufacturing, not invest, but give debt to manufacturing companies, to NBFCs, to mutual funds. And basically, we saw large corporates taking a lot of that debt. Also, we saw a lot of funding in foreign currency, which I will explain later. I've also mentioned here RBI measures for liquidity. Some of them have been a success. The long-term repo operations to some extent have been a success. But then they came forward and said, we will do these same operations because we want to give money to specific sectors. So they told banks, take money at a cheap rate from us, give it to manufacturing companies. So banks did that. Then they said, take cheap money from us, give it to mutual funds, because we saw the whole Franklin Templeton fiasco happening. So some mutual funds got money. They did this for NBFCs. Banks did not want to lend more to NBFCs. So we did not see a big take up there. A lot of the operation was a partial success at best. So coming back to fundraising, as I told you, the RBI has infused a lot of money into the economy. Also, please connect this with the Forex reserves, okay? So let's say, I'll give you an example. Reliance sells $13 billion worth of stake to foreign investors. Those $13 billion come and hit the Indian banking market, okay? Because Reliance works with, let's say, 15 Indian banks, PSU banks, foreign banks, private banks. So Reliance will sell these dollars to all of these banks, okay? Then the RBI will come and buy these dollars from the banks and give them rupees in exchange of that. So what happens is we end up in a situation where RBI has more than $500 billion of dollars lying with them. And we have a situation where banks now have a lot of rupees with them because the RBI has bought all the dollars and they've given them rupees. So now banks have so much liquidity. They don't know where to lend, and they don't want to lend. It's a bad time to lend. Coronavirus, supply demand side shocks on both ends. They don't want to lend that much. So they have again gone and deposited this money with the RBI. So we have seen a lot of these things happen. Very high liquidity, not that high borrowing. Then again, the US has also cut rates. They're close to 0.25% is their Federal Reserve rate. They've cut rates massively. The ECB has cut rates. The Americans and the European central banks have also gone forward and started quantitative easing. So they've started buying assets in the real economy just so that some growth picks up. So now you have a situation where euro and dollar funding is also very cheap. You can raise dollar funding at 1% per annum. Just an example. That's a fixed rate. You can do it on a floating rate, which is called LIBOR, right? US LIBOR. So you have a situation where big corporates are going abroad or asking foreign banks that give us money out of Singapore, give us money out of London, and then they're using this to fund themselves. We've also seen, as we had a question as well on bonds, we've seen bonds being active, we've seen commercial papers being active, but that market is only for highly rated players. Then a core bit, this might be slightly technical, but I will just give you an idea. How are companies hedging their foreign currency risk? Okay, we've covered USD INR in detail now, so you know rupee has been depreciating. Okay, so people are worried, importers are worried because they have to make payments. If rupee keeps on falling like this, their costs are going to go much higher, right? Because let's say rupee depreciates 2-3% more, that means their cost is increased by 2-3%. So we have seen most of the players in the market want to hedge using forward contracts only. So a lot of forward contract activity is happening, especially whenever dollar rupee is coming down a bit. Let's say rupee went from 76 down to 75. As soon as it starts dipping, importers start buying because they're also not very optimistic about the rupee. So whenever the price is better, they start buying in the future using forwards. Okay. So forward contracts have been there. Exporters have been transacting here and there, but they've been waiting because they expect better rates in the future. Uh, Now, to anybody who has a derivative background, a lot of people had taken money in dollars, in euro, in yen on floating rates. Okay. So these rates, interest rates keep on changing. A lot of times people want to swap this floating interest rate for fixed interest rate because they like certainty. So they saw that because markets were expecting rates to keep on going down in the future, they saw banks offering them a fixed rate against a floating rate at a much cheaper rate. So it's called an interest rate swap. And we saw a lot of activity. A lot of clients got into interest rate swaps. Okay. Another topic which I would want you guys to ideally focus on in the future is negative interest rates. Okay. Japan has had negative interest rates from the central bank for ages. Europe has had it for a while now. Okay. Uh, there are talks that the US might actually see negative interest rates with LIBOR going negative as well. So that is very interesting. We will not discuss this because it's a detailed topic, but I would suggest that you guys follow this, and you would really enjoy reading about whether it's been a success. Mostly it's agreed it's been a failure. Countries with negative interest rates like Japan have had negative interest rates for 5 years. Still, economic activity has not picked up. Inflation has not picked up the way it was expected. Again, a lot of people who are raising money abroad are swapping it into rupees and hedging their currency and interest rate rates at the same time. It's called a cross currency swap. So do read on it if you're interested in it. Now we will go to the last slide. Again, before we go to the last slide, which maps the future, I would just like to ask you if you guys have any more questions. So let's go to the chat. Uh, Guys, any more questions? I'll just pause for a minute. Please feel free to ask right now. No questions? Then I will assume, because we had a few questions earlier. Okay, so then what we do is we move. Okay, okay, we got a question. What is hedging? Okay, so it's from Ayushi. So Ayushi, hedging broadly means reducing your risk or capping your risk. Okay, and when you talk about hedging, it is important to understand what you are hedging. Okay, so I'll give a basic example here. Let's say I'm a company that exports my products. Okay, I could be any company. Let's say I make tables and I export tables to Europe and the US, all around the world. So I have payments coming in from those countries. So I sell a table in Europe, I sell a table in the US. The guy buying in the US will pay me in US dollars. The guy in Europe will pay me in euros, right? Now, in corporate world, you do not get payments real time. So it doesn't happen I sell a table today and I get the payment straight away. I will get the payment 6 months later or 3 months later, depending on my relationship with the guy. Okay. So let's say the guy tells me, you have sold me $100 million worth of tables. I will give you $100 million worth of payment 6 months later. Now I'm sitting here and I see dollar rupee. Let's say I was sitting in January and I saw dollar rupee at 71. Would I want to keep my risk open that dollar rupee could go higher or could go lower? Let's say if I knew about the coronavirus, I of course would keep it open because I'm an exporter. But what if I'm an importer? Let's say I import from Europe and I have to make $100 million, €100 million payment to them. And we see the currency, we see rupee move from 71 against the dollar to 76. I would have to pay 5 rupees more per dollar on $100 million. That's a lot of money. You know, my profit margin will explode. So what I will do is I will go to a bank and I will say, look, I want to make a payment 6 months later. Can you give me a rate for 6 months? Okay. Now I will not explain how that's called a forward. I will not explain how a forward works right now. You can read up on it. But if I want to make a payment 6 months later, the bank will give me a rate. So if rate right now is 71, the bank will say, okay, 6 months later, I'll give it to you as 73. Take it or leave it. So he says, fine, I'm fine with 73. I know my cost is 73 now. I can balance my books. I can do my calculations. Okay. So that is how I hedge my FX risk. And you can hedge other risks as well like this, which I will not get into, but that is the basic concept of hedging. Can you please explain quantitative easing? Okay. So quantitative easing, what happens is sometimes central banks have to intervene in the market in a more real way. So let's go back to 2008. Okay. 2008, you had a massive banking crisis in the US. Now, what has happened suddenly is that most of your biggest banks are in a situation where they'll go bankrupt. Okay. What happens if your banks collapse? Just imagine. In India, if SBI or other big PSUs or ICICI, all of these banks, HDFC, tomorrow say that, boss, we are in such a bad space that we might collapse. All of us would be very concerned. Our money would be at stake. The whole economy would be at stake, right? So what would the central bank do? The central bank would directly intervene in the market, will buy shares of SBI, will buy shares of HDFC, will give them money that they need right now so that they can do business in the next 3 to 4 years. They survive, they make back whatever they lost, and then the central bank can sell those stakes and get their money back. So that is quantitative easing, where you directly go into the economy and you start buying assets because nobody else wants to buy and nobody else has the capability to buy at that point in time. So we have one more question. So there is an argument whether there will be alternatives to the dollar in the near future, yen, yuan, euro, which may be ready for heavy appreciation. But do these countries, central banks, want their currencies to strengthen against the dollar? Okay, so euro is stronger than the dollar. Okay, the yen and yuan I would not put in the same bracket. Yen, I would. Yen is still a developed market, strong currency. Strong currency, not the exchange rate is bad. The exchange rate is 106 against a dollar, but it is still a safe haven. The yuan or the Chinese renminbi is an emerging market currency. It generally trades in a range. It is also heavily controlled by their central bank. Okay, so you would have seen that the US many times has put the Chinese on a list called people who, countries who are currency manipulators. So the currency manipulation list, Chinese are always there. So they intervene a lot in their currencies, and they want to keep the yuan cheaper because they export a lot. So cheaper currency is good for exporters. So do I see other currency taking dollar's position right now? There's been a lot of literature on it. Frankly, I don't believe it. Okay. When you have a situation where 70% or something like that of the world's trade is done in US dollars, it is not easy to replace that overnight, or let's say even in the next couple of years. The only reason I see of a shift happening is if I see the US and their economic prowess go down significantly. They're a military superpower, they're an economic superpower, and they will hold that for quite a bit of time. The Chinese are obviously aggressors, but I really doubt that they have the capabilities or the trust of the world. Now, consider this situation. The Chinese are in a situation where they're fighting with a lot of countries, right? They're having border disputes with Australia and the South China Sea, with Southeast Asian countries, now with Japan, obviously with India. So why would somebody want their currency to be of more prominence? So and euro, of course, the European zone has been struggling economically. Japan has been struggling economically. I don't see any other currency as of now taking dollar space. Is it a good time to invest in banks? If you remember, we had this SME space chat right now. I would wait. I would wait. Banks, I think, are going to be in some trouble right now because there are going to be a lot of stressed companies. There's got to be a lot of resolution. I think the IBEA code now is going to get tested in a real sense. So we are going to see some troubles in banks. I would suggest against investing in banks for now. Okay, so we will move to the last slide. And after this, we'll take some more questions. Now, what I've tried to do here is I've tried to define. Now, whenever you have an opinion about a currency, please understand you can be wrong. Okay. You never know how things change sometimes, but it is always good from a longer term perspective to think of currencies from positives, what could be possible positives for a currency pair, what could be possible negatives, and what are areas I need to watch closely. And that's what I've tried to do here. Let's start with the positives. The rupee has not had a lot of positives in the past. The rupee has been the worst performing Asian currency in 2020 so far. It was the worst performing currency in Asia in 2019. It was the worst performing currency in Asia in 2018. So it's been doing badly, you know. It's not been performing well. But what are the positives? As I told you, the 2018, 2017 spike that we saw because of oil price rise 2017, 2018 is now not the case. Oil prices came down significantly. You saw a situation where, because nobody was consuming oil, and Russia and the rest of the OPEC and the Saudis were basically in a situation where they didn't want to cut production. They were having some battles in between them, so they kept producing oil and nobody's consuming. There came a point where there was no space to store more oil. So what do you do? So you're in trouble, right? So now you look at the US industry with the shale oil industry there. uh, the, the WTI, the Western Texas Intermediate, which is their benchmark for oil, uh, actually went down to close to zero, and futures, like future oil prices 2-3 months down, were trading in the negative. So that means people, because they had overcapacities, were telling people, you know, I will give you oil and I will give you money to buy my oil. So that is very counterintuitive, right? But we got to a situation like that. Since then, production cuts from OPEC and in the US has seen oil recover. But oil still remains low, close to $35-40 a barrel. I haven't checked what it is today. So low oil prices, I think that is something which is going to be a positive for some time to come for the Indian rupee. We also saw some sustained inflows. So of course, some of those inflows was because of Reliance, or Kotak Mahindra also sold, not Mahindra, Kotak Bank sold 1,000 crores, $1 billion stake. So we saw some inflows coming in from there. There are some large flows in the markets. We expect dollars to come in. Uh, so that will help the rupee. But do we think it's sustainable? Not really. There are a few large corporates who are raising money, but beyond a point that would also dry up. So that is a bit of a positive for now in the short run. Market reforms is another positive. The RBI has been becoming more and more reformist in the last 1-2 years under the new governor Shanti Kanta Das. I think RBI has done some interesting things because government borrowings are increasing. They also did something known as Operation Twist. So this is something you can read later. Okay, they started buying and selling government bonds of different tenors at the same time, so that they can adjust the rates of at which the government borrows. Okay, Operation Twist. So you can read about that later. They also, as I told you, increased rupee trading market hours. They allowed Indian banks to trade in the NDF markets. Another very big change, and please do read about it, is that they have allowed banks to go and deal in exotic derivatives. Okay, exotic derivatives are complex derivative products which were allowed in India between in the early 2000s, late 90s, early 2000s, right up till 2007, 2008. 2007, 2008, in the global financial crisis, a lot of Indian companies, derivative prices become very volatile during such crisis times. So a lot of companies went bust because banks were selling exotic derivatives to all sorts of clients, including SMEs. So it was a lot of mis-selling, as they call it. So RBI stopped those derivatives altogether. Now they think it's a time where they can be reintroduced. So they've done it now very smartly. They've only reintroduced it for companies with more than 500 crores of net worth. So what that does is it basically allows only the sophisticated players to participate in it. The Reliance and the Bharti Airtels and the other people of the world who are active in options. Dollar weakness. So we've been talking about dollar strength. we are seeing that the dollar strength is peaking, okay, because the US is having more and more problems, okay. It is the country with the largest coronavirus count. It is a country where there are internal troubles, with the Black Lives Matter and the whole movement around it. There are some civil unrest, so investors are not very happy about that. And then there is also a situation where they have elections coming up now, so you are going to see a lot of rhetoric being thrown around. And of course, they're facing a lot of other problems too. So going forward, we might see some dollar weakness. Do I anticipate it to be very weak? No, because other parts of the world are also facing a lot of problems. But there might be some which might be a positive for the rupee. And dovish Fed. So this is a market term. The central bank is hawkish or dovish. When they're decreasing rates and they are doing quantitative easing and pumping money in the economy, they're dovish. They're trying to prop up the economy. So a dovish Fed uh, will mean lower interest rates in the US. Lower interest rates means generally a weaker currency. So if we see negative interest rates, I'm sure it'll have an impact on the US dollar. Now, areas to watch. Or before that, let's come to the negatives. There's a big list of negatives. Okay. The COVID-19 disruptions have been massive in India. We've all seen that. We've all experienced that. So that is not something that we need to, uh, think about or even debate. It is going to have a massive impact on the Indian economy. It is estimated that we will contract. Now, the IMF just this morning actually also updated their economic forecast for India, saying that they don't expect the economy to contract 2%. They expect it to contract by 4.5%. So that is very bad news. I think the whole crisis, as of now, not assuming a timeline, will push us back at least 2 years in terms of where we were 2 years back with our GDP. So it's very bad for us. And the fiscal deficit is skyrocketing. From a 3.5% budgeted fiscal expenditure, we will go to 12% consolidated deficit. That means the center plus states. 12% of the GDP is huge. So traditionally, India was not a high debt country. We had a debt to GDP ratio of about 60-65%, which is generally considered very good, because the global average is close to 90%. Now we will actually clear 90% in one go. So we will clear 90% debt to GDP, which is bad. Then the RBI, as I told you, has been constantly buying whenever the rupee is trying to go higher or appreciate against the dollar. RBI did not allow rupee to go below 75, so which I think is a negative. They have a depreciation bias, so we expect the rupee to move in the opposite direction in the next 3 to 6 months. Heightened border tensions, I mean, we obviously know what's going on there, and you don't know what the outcome is going to be, from an aggressive Chinese posture to what we can do in terms of defending against it. There might be more scuffles, there might be more issues, there might be more diplomatic skirmishes. So that is bad for the rupee again, very, very bad. Another big and important point is a lot of FDI used to come in from China. Chinese were big investors in India. And I have personally seen this where I've gone and met Chinese clients and Chinese firms. And they were investing left, right, and center in all sorts of businesses. They were investing, obviously, we know in electronics, they're very big. We know they're big in telecom with Huawei, like telecom service providers that provide equipments to companies. They are big in auto, now becoming big. Great Wall and a lot of other companies coming in. They're becoming big in the NBFC space. They were investing in NBFCs. So they're everywhere. Now what the government has done is, because of the current standoff, they have blocked all FDI from China. By blocked, I mean earlier a lot of sectors were automatic route, so they can just come in and invest. Now all of them will have to go through an approval process. Approval process, of course, takes time. So that money coming into India is going to dry up. Again, a negative for INR. Another is low interest rates in India. So as I told you, low interest rate in a risky economy, why would people want to invest? And please think of it from a perspective that, like even people like us, if you're putting money in a bank, the savings interest now is so low. I don't know what even it is. It's probably 2-3%, 1%, 3% probably, from what SBI is 2.5% on savings. It is so low. People say, okay, I'm literally losing money by keeping my money in a bank account. So it's similar with investors. They see that India on an interest rate curve is going down. So they will not be very happy about it. That is a negative for the rupee. Uh, I explained the risk off sentiment. So that is also another negative. There's a big risk off sentiment in the markets right now. A lot of you might be surprised and you might be thinking, talking about a risk off sentiment, but why are equities going higher and higher? Nifty and Sensex has recovered, not obviously to pre-corona levels, but they've done pretty well in the last few weeks, and people have been surprised. And that has been a good thing for the rupee, as I told you, sustained inflows on equities as well. But I think it is only for a very small period of time. What we have seen is, and there was an interesting article on this as well, saying that more and more consumers, more and more private players like people like us have started investing in the equity markets recently because people are at home. So you look at figures, tons of new brokerages accounts have been opened. Ton of people are now started investing in equities. So we've seen a bump up, but earnings are not that positive. The economic situation is not that positive. So I think the equity markets are wildly off from reality. And we will see it reversing at some point or the other. If we don't, then it's just a bubble creation, in my opinion. Apart from that, fiscal packages, a lot of people would have heard the government has announced 20 lakh crores. That 20 lakh crores was a disappointing because the reason is large part of that 20 lakh crores, they also included the liquidity measures from RBI, which accounted for, I think, 4 to 5 lakh crores out of that 20 lakh crores. So that is not something which is a fiscal stimulus by any means. That is something which is a monetary action. They shouldn't ideally include it at all. We have seen monetary action in the US and the UK and Europe amounting to trillions of dollars, about trillion and a half, 2.3 trillion in the US was the fiscal package as well. You obviously cannot have that in India because we right now do not have the fiscal space to do it. I agree with that. But then the 20 lakh crores is, I would say, an inflated figure. Then you also look at what they've done in terms of the fiscal side. They've announced mostly reforms, which are not, again, fiscal measures. They will have some impact going forward. They have also, what they did was, they said 3 lakh crores of guarantees, loan guarantees. That again is not a fiscal stimulus, okay? 3 lakh crores, understand. The banks are giving the money, the government's not giving the money, they're not giving any additional money. All they're doing is they're guaranteeing it. So in case these people fail to repay it back, the government will guarantee those. So you can assume a 10 to 20% pessimistic rate of defaults in 3 lakh crores. That means about 60,000 crores in the future. So fiscal stimulus was very disappointing. High banking NPAs, as I highlighted, they're already very high for PSUs. And post the moratorium, it might increase sharply. Subdued domestic demand and supply. Now, most of the problems in the past, the crises in the past, have been either demand side crises or supply side crises, right? So if, for example, Japan has been facing demand side problems for years, people are not buying new things. Same as in Europe, even with negative interest rates, people are not buying. When the Saudi facilities were bombed by drones, we saw a supply side shock in oil. We saw oil prices shoot up, and we saw dollar rupee shoot up as well. That we are not facing either a demand or a supply side. We are facing both. So more of a demand side but even considerable supply side. So especially in terms of global trade. So that is again a big negative. Now, quickly, what are areas to watch? I would say, obviously, the COVID trajectory. Where are we going? Nobody knows. We are seeing record rises every day. We don't know where the peak is. I mean, flattening the curve is I think, a distant reality right now. Then vaccine developments. Whenever you hear that some clinical trials are going well or new vaccine, potential vaccines are coming into play, you see positive reactions from dollar rupee. You see INR giving positive reactions. So it's a thing to follow. Now, once things get better, what would be the economy? What would the economic recovery be like? Would it be a V-shaped recovery? Like, does it jump up, or is it a long-drawn process? So please follow that. Border tensions, again, central state government revenues, I told you, high fiscal deficits. How global economic recovery is going to pan out is also going to be very important from a trade perspective, right? Global stimulus packages, if there are more stimulus packages abroad, but nothing in India, would be negative. And this is the last point I will concentrate on, which is Indian sovereign rating. This is very, very important. Okay. Uh, India, if you see, is rated as the entry level investment grade by Moody's, Finch, and S&P, all of them. Okay. That is generally triple B plus rating. Now, we have seen in recent times, Moody's had given a higher, slightly higher than triple B plus. They came down to triple B plus. We saw Fitch changing their rating from outlook stable to outlook negative. So now we are in a position where we are at entry level investment grade as per rating agencies, which is good. But if we go one level lower, if we get a downgrade from any credit rating agency, we will see a very, very bad reaction from USD INR. INR will depreciate sharply and move ahead. And this is not only a USD INR problem, it's going to be an economy wide problem, because government is borrowing right now at interest rates which investment level countries will raise money at, you know. But if you become what is essentially a sub investment grade, or also known as a junk category, then your borrowing rates will shoot up. So you will have massive problems on the fiscal side. You will have a lot of bad investor sentiment. All of this will be very, very negative. Now, finally, what is the road ahead for USD INR? Are we moving towards 80? So we started 2020, as I highlighted, on an optimistic note. Rupee strengthened and then waited in a way for any directional cues. The directional cue was not a normal one, it was a very substantial one. And those unprecedented shocks pushed Rupee to continuous all-time lows when it crossed 74 and went up right till 76.90. Then post that, I would say in the last 1 to 1.5 months, we have seen Rupee being more stable. It has traded in a range between 75 on the lower side, where we see RBI coming in, and 76.50 on the upper end. And right now also is my firm belief that the currency again is in a situation which it was in early 2020 in January and February, that it is waiting for some major news to break to give it the next directional push. And what that break would be is anybody's guess, but the odds are stacked against the rupee here, because I mentioned the negatives and it's a much longer list than the positives. And so are the areas to watch. And most of these areas are on the negative side. So I would ask people to very closely follow these points, and you will be able to see an impact whenever we get some major directional news. Also, are we going towards 80 is a view which a lot of people have been discussing. Traders in the market also believe we can be headed towards, or we are certainly headed towards 79 to 80. I don't like to use the word certainly, because currencies, like any asset classes, can be unpredictable at times. But there's a very, very high probability, certainly in the majority, that it will move higher. And there's also a good probability it might go to levels of 80. And that is a view which is also shared by Venkat Thiagarajan, who was the former FX head of Reliance Industries. And the reason I've quoted him is, and this was an article of his on Bloomberg, you can go and read it, is that Reliance has one of the most sophisticated treasuries, not only in India, but in Asia. These guys have huge foreign currency exposure, and they do a lot of fundraising. They do a lot of derivative structures. Their treasury is probably more sophisticated than bank treasuries. They are very good. I met a trader, a treasury and markets trader in Singapore, who told me that he used to also deal with Reliance in the Indian market, a very senior guy, a director. And he said that that was one of the best experiences he had, just because they had such a sophisticated treasury there. So keep an eye out on 80. And the only possible out, so is there any way that dollar rupee can avert this fall to 80? I think the only fallout is if we have some positive news on COVID-19, and we see a V-shaped recovery in the economy. And because RBI has a lot of reserves, which by the way will help it if it gets downgraded as well, because those reserves will be a good buffer. if we see RBI intervening on the other side, that means it stops rupee from going lower or dollar going higher. I think that are the only outs. But all of these three need to happen at the same time. And from any realist's lens, I think that at the moment doesn't seem very forthcoming. So finally, that is it. I'll end with a quote, and it is: a weak currency is a sign of a weak economy, and a weak economy generally leads to a weak nation. So we are not there yet, and I really sincerely hope we don't get there. But I think at some point in time over the next 4 to 5 years, there has to be a concerted effort from the government and the RBI to ensure that rupee strengthens and does not continue this on this bad path. So thank you guys. Thank you very much. On dot, it was supposed to be a 1.5 hour session. We finished in 1 hour 25 minutes. Last round of questions, and then we will call it a day. So if I can just go to the questions. Okay, so we have one from Aman Agarwal right now. Please, during that time, feel free to post more questions. Can Bitcoin or any disruptor technology be the first big challenge to the global fiat money system since the modern state retreated from the classic gold standard? I'm asking this question from the viewpoint of an Austrian school economics course who attributes scalability, sellability, and stability as the main features of any valid medium of exchange. So do you see a denationalization of money as written by Hayek? Okay, so that's a very pertinent question. But I do not see that happening anytime soon. And I stated some of those reasons earlier. See, I am not against the idea of cryptocurrencies. I think they're a great idea. A lot of the underlying technology is very advanced and can lead to massive efficiency gains. But at the same time, it's an up and coming market. And the model hasn't been tested yet. So for it to become national, leave global, and replace existing currencies, first of all, it needs to prove at a smaller scale that it can hold value. So your point here: scalability, sellability, and stability. So stability is number one. Cryptos, unfortunately, are very speculative in nature, right? Going back a couple of years, we saw Bitcoin fall down from what, 19,000 to back to $3,000-4,000 levels in a very short period of time. That generally will never happen with a mainstream currency, and it shouldn't happen with a mainstream currency. Otherwise, what you will have is, you will have a situation like what Zimbabwe faced in the past and is facing again now, and that is hyperinflation. Your currency would be worthless, right? So first of all, I think it's in very nascent stage. It will take a long time, and I don't think anybody can predict how long before we even start talking about replacing existing currencies. I think there's a lot of good points in cryptocurrencies. It's an area to watch. It is an area where people can build businesses. First, they will need to test it as a medium of exchange at a smaller scale. They will need to establish an underlying value to it. They will need to price it against other currencies. So what people don't realize is, people invest in Bitcoins and Ethereum as if they're an asset class on their own. Currencies don't trade that way. Currencies trade against other currencies. So INR is weakening against the dollar, and hence is weakening against other currencies. Cryptos are not priced against other currencies at the same scale. So of course you can say that, okay, you can buy one Bitcoin for $9,000. I'm just giving an example. I don't know where they're trading right now. But is that an exchange rate? No. Is that a developed FX market? No. Is there any liquid derivatives that people can use to hedge their exposures? No. Is there any acceptability? Maybe I can buy a pizza from one shop out of 1,000 on cryptocurrency, but it's still very small. So follow the space. It's a good space, but as a counter to traditional currencies, not at the moment. But nobody knows after 20-30 years maybe. But unified currency for the whole globe seems very difficult, because the world is getting more and more aggressive towards each other. I see a trend where globalization is actually reversing rather than strengthening. So people are getting more protectionist, and everybody sees that. So global currency, right now, I don't see anywhere near that stage. Great. Any other questions? Yeah, considering the investor's psychology and fact that equity markets are seen to do well, do you think it is plausible that we might witness similar outcomes such as the rising prices of assets in general, similar to what happened in 2000 crisis in the near future? It's a slightly confusing question. But plausible that we might witness similar outcomes such as the rising prices of assets in general, similar to what we happened during the 2009. So what I see on the asset front from this question is I see equities, and equities have recovered a bit globally. I see equities facing some trouble. And the reason I say that is people do not have liquidity beyond a point, right? Right now, people with liquidity are still spending. But if this stretches 3 months, 4 months into the future, you're going to be in a situation where people are going to be very wary of investing in any sorts of assets. Companies are going to be facing headwinds. I think right now, we are not seeing actual earnings coming through, right? It's been 3 months. Earnings will come in the next 3 to 6 months. So you will see the impact, the demand side impact that companies are going to face in the future. And that is going to lead to, in my opinion, a correction in equities across the board. Can we see more speculative buying? But as I said, we could. Of course, equities can move counter-cyclically. So can any asset. But that would be a bubble creation in my opinion, because there won't be any underlying value to it. Talking about other asset classes, if we talk about commodities, we've seen gold near all-time highs, which again is not surprising because gold is a natural risk-off asset. It is generally seen as a hedge. So I see commodities like gold doing well. I see currencies, stronger safe havens doing well, emerging market currencies in for pressures, and I see equities under pressure. So that is broadly it, and I think we are sharp on time, and we should conclude now, and I've concluded already, and we've taken the questions. I think it was great. I had a great time. I will now ask Ajay, and I first would like to thank him for the opportunity. It was a very good experience doing this. Thanks, Ajay. Over to you.
Yes. Pranjal, thank you so much. I think that was really informative as well as a really interesting session. We've sort of discussed some of these core areas multiple times, but I think I've got something to learn even this time around. So I think on that, it has been absolutely brilliant. I had a couple of questions of my own. I think from the core point that you did discuss, I think we could explore ideas pertaining to the theory of reflexivity, especially with the RBI thinking that, okay, dollar is going to rise, and then they also act as an actor within that domain where they make the dollar rise by sort of piling up on their forex reserves.
Yeah, that's very true.
That's something I do understand, that we're sort of closing our session here, and we can either have another session about it sometime, or most certainly we can continue this conversation further. So thank you so much, Pranjal, and thank you everyone for joining us today. I think we had a huge audience, and it was sort of constant throughout. So thank you so much for being a great audience. And I think all of our mentees, and for those of you who might have missed parts, or for those of you who weren't here, we will be uploading this session on our YouTube channel as well, and all of you can sort of take it from there, right? If you have any questions, if you have any concerns post that, I think, like I said, that we still have some questions coming in, but I think those can be directed to Pranjal through email, and I'm sure you'll be taking this up with your specific mentees as well. Right, so thank you so much once again, Pranjal.
Thanks so much, Ajay. Thank you.
Session. And thank you so much, everyone, for joining. Right, Kishika, Aman, if either of you is here, then we can sort of conclude the session, or I think we can just sort of start pressing leave. Okay, thank you so much.
Thanks, guys. You can send me any questions over mail. We're more than welcome to please do that. Thanks. Thanks, Ajay. Thanks, guys. Bye.